Welcome to the All About Alts podcast, where we explore the world of alternative investing to help you find financial independence. Join our host, NewView Trust's president, Jason DeBono, as he covers a variety of topics with different guest speakers to discuss tax and alternative investing strategies. It is never too late to start taking control of your financial future, and we are so excited for you to be joining us for this opportunity to hear from some of the best in the business.
Hey, everybody. Welcome back to the All About Alts podcast. I am your host, Jason DeBono. Super excited today. We get to dig in and talk about taxes. We are really lucky today. We don't just have one guest, we have two guests, both from the CPA world, Amanda Hahn and Matt MacFarland of Keystone CPA. How are you guys?
We're great, Jason. Thanks for having us. Appreciate it.
Excited to be here.
Well, this is one of those areas. I think I say this a lot, and you those that listen regularly, I know I've said it multiple times on the podcast, and this is not a shameless plug just because you guys are here today. But I tell people all the time, the best professional that you can have in your corner is a good tax professional. It doesn't mean that it's always the best professional. There's a time where legal or other groups provide value, but the tax professionals, A, are hard to come by. B, they're hard to find the ones that understand, especially what we as alternative asset investors do. And so the fact that this is square down the middle of the plate for you guys is going to be a lot of fun today. Y'all ready to get into it?
Let's do it.
All right. So let's go back. So you guys both have background at the Big Four, right? Which is the large accounting firms that kind of rule the world, if you will. They do a little bit of everything. But what's unique is you both have real estate investor backgrounds, and a lot of your clients going forward and the types of business you service are real estate investors. So how did that kind of happen, right? Most accountants are accountants. How did you get to be a real estate investor? What came first, the chicken or the egg? And what's that journey look like for you guys?
Yeah, thanks again for having us. Appreciate it. Yeah, it's true. We both did get our start at a Big Four accounting firm. She worked in kind of more of the real estate group. I was working in the, high net worth individual private client advisor group, where obviously, started my career when I was 22. So you work on people who in private client advisor, they all have real estate, right? You kind of learn that really quickly that's a wealth vehicle that everyone was utilizing. And I think I kind of had my aha moment. I was probably 24, 25 years old, a couple of years into my career, and reviewing a gentleman's tax return. He's probably in his 60s. He was retired. All he did was real estate, but you quickly could figure out on the tax return, when you add back the depreciation expense, this guy was making over six figures in cash flow and not paying taxes on it. I was like, okay, there's something here, So that's when I kind of, got the ball rolling for me, that this is something I liked, understood, and wanted to kind of learn more of.
Yeah, I think I had a different journey. I actually grew up from a family of real estate investors. So my grandparents did real estate, my parents did real estate. And my goal was to never do real estate because my grandparents were really hands-on with properties. And growing up, I just kind of saw a lot of all the hard work that went into real estate investing when you're a very hands-on landlord. And so I kind of didn't want to do that. So it was, actually Matt was the one that convinced me, hey, we should really, buy some real estate. That's kind of what we do as CPAs. So why not have our own? And I recall I looked at him like he was crazy. I didn't.
She looks at me like I'm crazy every day, but yes.
That's true.
Yeah, some things never change.
Yes.
Well, what I love about, kind of understanding how people get into stuff is, the key goal is for our listeners to think about, it doesn't matter where you are. Some people walk in the front door, some people walk in the side door, some people walk in the back door. But I think what I loved about kind of hearing, you had two totally different experiences in real estate, right? One that was, visually through clients, and you were seeing them on the wealth side. Right. And so that's a pretty attractive thing. Hey, I want to be 60 and make six figures, owning real estate and paying no tax. So you had this vision of what life could be like. And then, Amanda, for you, you're on the other end of this, you're watching grandma and grandpa, rip out dirty carpet after the tenants move out and complain about all the hard work. I had a similar viewpoint through my dad in owning real estate. But it's amazing that when you kind of step back and level set, you realize there's no one single solitary approach. And so it sounds like you guys have kind of honed in and maybe used some of those experiences that you have, again, through different, visuals in your life to kind of figure out where you want to be in the real estate market.
Yeah, it was really interesting because, growing up in the big four accounting firms, we just, worked with a lot of, mostly, high net worth, high income individuals. And when people are at that level, it's very common for them to be talking to CPAs all the time. Our clients it was normal for them to call us before transactions when they had questions and to do planning throughout the year. But it wasn't until Matt and I, when we decided we were going to invest ourselves, we had to start at the bottom, right? We didn't really know anything about real estate. So started going to real estate meetups and just meeting more of everyday investors. And that was the first time when we realized that, hey, most people don't get to do tax planning. They don't even know that it existed. It was kind of just, hey, we pay the taxes we pay. I guess it is what it is. And so that's sort of the beginning of what sparked our passion, and just making sure that the everyday investor understands that there are ways to save on taxes, and it's not just for the super wealthy or clients of the big four accounting firms.
Yeah, building wealth, we're so laser focused, and I think it just part of that is every investor's on their own journey, right? And they've got to start somewhere, and we get so wrapped up on return. How much am I going to make? How much money is it going to return me, that we don't actually think about how do I keep the money that gets returned to me. And the high net worth investors, they all have it figured out because they finally made enough money to figure it out. But this isn't a secret of the wealthy, right? Anybody, if you own one property, you can use the taxes or the tax benefits of real estate really to your benefit. Even with just one property, you don't have to own a lot of stuff to get there. Is that a fair way to put it?
Yeah, absolutely. I think that's a big misconception that we hear a lot. I think for various reasons, people, in the media, maybe might even be CPAs out there to kind of will tell you, hey, well, you can't, if you're not doing real estate all the time, there's no benefits of doing it, investing in real estate. And that's really the farthest thing from the truth. I think that kind of unfortunately takes a tunnel vision approach to, wealth building, tax planning, whatever you want to call it. So yeah, I think for those people out there that maybe haven't started yet, right, to your point, there's never a bad time to get started. The sooner the better, in your wealth building journey. And that's why 85-90% of our clients probably work with real estate to some extent, whether it's full-time or kind of just getting started like that too. So it kind of runs the gamut for sure.
Yeah, we've seen even one property really change the trajectory of someone's wealth building, for the people who are maybe even like accidental landlords, where they have a home and they get married and then they turn that first home into a rental property. And everybody, regardless of income level or how much time you spend in real estate, if it's full-time or part-time, we can always use these tax benefits like write-offs and depreciation and be able to get income that is either not taxed or very low tax because we have all these offsets against it.
Well, one thing that we talk about, I love your perspective on this, from the other side of this table, is something that we really try to talk to people about is you got to reframe the way that you view your tax professional, and you got to reframe the way that you view taxes. Taxes are not a April 15th planning session and an April 16th you forget about it, right? Like taxes are a long-term play. And I think for most people, they train accountants to be tunnel vision because they give them all their tax paperwork, and they look them square in the eyes and they're like, save me as much money on my taxes. Save me as much money on my taxes. And what they really should be saying is, hey, I want to pay as little as I need to, but I want to make the best decisions for the next 50 years. Because those are two different approaches. One, you're going to go, okay, that deduction, we saved you, 12%, let's move on. Where the other approach is, hey, I may only save you 8%, not 12% today, but we're going to set up these next 6 or 8 moves over the next 5 years to save you 30, 40, 50%, 20 years from now. Is that a fair, do you guys feel that as accountants when clients talk to you, and how do you coach people to just think differently?
No, I mean, you hit the nail on the head, right? I think that's a big mistake that we see a lot is people assume that the person preparing their tax return is going to do tax planning for them, right? Like you go and you sit down and whether it's, I mean, maybe it's better than April 15th, maybe it's April 1st, right? But regardless, right? You sit, hey, they think this person's doing my taxes. They know all my information. Of course, they're going to bring tax planning ideas to me, but in reality, if you think about it, most CPAs on average, we read a study recently that was, they're filing 500 to 1,000 returns a year, and they're working 16-hour days. So, I mean, if somebody really thinks that person, that tax preparer is actually going to do proactively think about what's coming for the next year or next 2 years for you on April 1st or April 10th, I think we all know the answer to that, right? So that is a big mistake we see.
Yeah, it's funny because well, one thing we used to say is when you meet with your tax person in April, they basically tell you what your taxes died from last year. Like, it's too late to implement any strategies, right, for last year. Now, of course, retirement contributions, retirement investing is one of those very few things we could still do now for last year's taxes. But for the most part, yeah, you're exactly right, Jason. Like if we're saying, how are we going to pay no taxes? For a lot of people, it's going to be like a 3 to 5 year plan where we got to plan ahead and say, how do we get there? What are we working with? Where's our income now? How do we get to have the right portfolio so we can actually make an impactful dent in what our tax situation is?
Well, there's nugget number one for everybody. Make sure that you are asking and inviting, right, and partnering with your tax professional with some vision. If you're looking at this as just a one-time, let's get this done and let's save money on taxes, you're not going to lose the game doing that, but you're going to have a hard time winning the game doing that. So, ask yourself, I guess you got a little bit of time since we're here in May of, whether or not are you going to wait till April of next year to have that discussion? Are you going to pick up the phone and invite your accountant to give you that feedback where it makes sense, and don't be scared to pay for it. It's pretty darn cheap advice in the grand scheme of it all, especially since it's one of those bits of advice that actually has savings to offset on the back end. So let's transition a little bit because I want to talk about real estate. I love that you guys ended up in real estate, right? Both with slightly different, but similar tax backgrounds. Right. So you're at this, you're at the dinner table, right? Talking about real estate. Amanda's thinking you're crazy. Matt's like, I know I'm crazy, but it's still something we should do. What did you go out and do? What was your first deal? What did it look like? What was the good, bad, and ugly about it?
Well, it's funny you say that because when we and I guess for everyone's full disclosure, who doesn't know, we are married to each other, so we live and breathe taxes 24 hours a day, which is highly recommended, I'm sure.
You make it sound very sad
right.
and crazy. It's not true at all.
Right. He was the one who said crazy. I didn't say crazy. But, no, but it's funny is that when we decided to start our own firm, it was 2008. Kind of, real estate market was still doing well. We had this great idea that, hey, we were going to help commercial real estate investors kind of analyze deals. We would get a percentage of the deal on the back end and kind of do the due diligence for them, the accounting, the bookkeeping, the taxes, and we just ride off into the sunset, retiring on real estate in a few years, right? And then obviously we all know the market crashed. So it's like, okay, well, we're good at doing taxes and tax planning for real estate investors, so let's focus on that instead of this due diligence side of things. So yeah, I mean, we got started on our own kind of real estate, investing in single family houses. We have some stuff with our family and stuff, but over the years, we realized that, this plan of being a full-time real estate investor didn't pan out for us because that's not what we're good at. We're good at doing, tax planning. So that's where we focus our time now, obviously building our business. But yeah, we've got single family houses, condos. We invest in a lot of syndications. That's kind of a benefit, I guess, of working with real estate investors if we see good deals. And so we can kind of jump in those when we see them.
Yeah. I think our first deal was probably the scariest for us. I'm from Las Vegas originally. So our first rental property was in Vegas. And, but, back then it was like, gosh, I didn't know. I thought I was crazy to want to invest in real estate, but now looking back, like Matt said, back in 2008, 2009, 2010, it's like I wish I would have bought a dozen or dozens of properties at the time. So I always tell people the first deal is the hardest. You have to talk yourself through it. And as accountants, I think what people might be surprised to know is even for our first rental property, We bought it sight unseen. I mean, we saw the listings online and stuff, but we made an offer, flew to Vegas, signed the paperwork. We never actually walked through the property, which I think for a lot of investors, their first deal, they want to kind of see it and touch it and all that. But because we're such numbers people, for us, it was like, well, the numbers worked out. So let's go ahead and jump on it.
Well, isn't hindsight 2020 for sure? I think we all would have bolstered our portfolios in 2010. I remember the first real estate I did. A friend of mine and I, we bought a duplex for $60,000, and it was renting for $700 a side. I mean, like it sounds like silly telling people. And there was probably 4 or 5 on the street we could have bought, and we were too scared to buy more than one at the time. And
you don't want to compete with yourself. Come on, that's scary.
It was like, I don't know, $600, and you look back now, and it's like those numbers just they were numbers that you could not lose, right? I mean, they were absolutely insane, just the cash flow from one side. But I think the lesson I learned as an investor is that the numbers tell the story. And even as we kind of look, we've been on quite a bull run, and there's a lot of people that are saying, well, I don't want to buy real estate right now. And it's like, the market, you're never going to time it at the bottom and the top and the bottom and the top. You got to be cautious if you think you're closer to the top, and you got to be more aggressive if you think you're closer to the bottom. But overall, a good portfolio, balanced, being bought multiple times, you're going to end up, if you got staying power, you're going to be in just good, if not great shape. So I learned a lesson through that process, but I definitely did not buy it sight unseen. So good for you guys. I bet I circled that property.
I don't know if that's good, but yeah.
Yeah. Well, let's kind of keep things moving on the from a business side. So you started a business with a purpose, right? And I think people probably look at what you guys are doing today, and you guys have been Bigger Pockets, CNBC, talks on Google. I mean, you've been invited to a lot of places because you guys have done and built such a great business, but it wasn't always easy. It wasn't what you started out intended to do. So talk to people about that. I think sometimes people, we lack resiliency as we want to go out and build our wealth, and you have to be resilient. You are never going to get it right out of the gates. And if you do, God bless you. But talk to us about that. You started this business 2008, which was probably, at the brink of the Great Recession, if not already kind of into it, but not showing enough signs yet. What was that like? How did you kind of have those discussions? And then how did you kind of reinvent or change the business path going forward to match the market conditions?
Yeah, I think it's really interesting, is because when we did start it, I was working kind of a 1099 as an independent contractor. Another CPA firm was like, hey, we can do this on our own. Let's do this. And everybody thinks when you start a business, I don't know, at least I did. I thought, hey, this will be not easy, but like, we'll make money quickly. It'll, we know what we're doing. Obviously, we're smart, blah, 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 insert whatever adjective you want, right? But in reality, it took us I did independent contractor work for 3 years before we had enough business and clients for basically both of us to kind of stop working that other job, if you will. So in our experience, it takes a lot longer than people, I think it's going to take, right? We had a colleague who's like, hey, it's going to take you double or triple the amount of time you think before you can replace the income you used to be making. And I mean, he was spot on, So I think that was learning experience for sure, but it was a great learning experience because you had to, obviously do what you need to do to get by, and and kind of make those changes in the business and keep growing it, and focus on growing it.
And I think also just we shifted our focus, like Matt said, when we first started out, we said, okay, we're going to help commercial real estate investors, deal analysis and that, that type of stuff. But the need or the demand shifted because it was a downturn. There was a lot of foreclosures, cancellation of debt, and that involved a lot of tax planning. And so we sort of became the experts in that arena. Like if you were a real estate investor, you were way underwater, you're asking for forgiveness of loan, you don't want to pay a bunch of taxes on it. We were kind of like the people that you would call.
We were good at that.
Yeah, like we did a lot of webinars and really we led with education at the very beginning because it was like people didn't have money to pay CPAs. So we just kind of decided to teach people, how to get out of a bad situation. We used to do this webinar we call Turning Lemons into Lemonade. we talked a lot about, hey, okay, the reality is we got a bunch of tax losses. And I'm not talking about depreciation. I'm talking about real losses. How do we come out of that and come out of that ahead? And so, yeah, it's really about pivoting too. Like we started out this way. We quickly knew this was going nowhere. And we got to take a little bit of a side road to get to where we are today.
Well, good for you guys for making that turn. I think a lot of business owners, entrepreneurs, solopreneurs, they just kind of assume that this is how it works and success is just, we just got to keep plowing towards it. And yeah, sometimes you got to go a little left to go a little right to end up back at center where you were. So I appreciate you guys sharing that, because I think it's something that's so overlooked. And it's, I think, Matt, you mentioned it, like you were naive starting the business, you felt this isn't going to be that hard. And it's amazing how sometimes what you think is going to happen, does, and you feel great about it. But most often, something that you didn't expect to happen does. And it's the business owners that are resilient, that kind of roll up their sleeves and figure out how to, get through it if they can't get around it. And I think that's something that it's exciting to see you guys on the other end. And here we are, 15 years later, 16 years later, and business is going great and strong. And I'm sure there's been a few pivots in your past, and probably a few more ahead, as the world continues to turn. I want to talk a little bit on the tax side, but before we get too we get too deep in the weeds on taxes and real estate, let's maybe add a little levity here and switch over to our quirky questions of the day. We're going to put you both on the hot seat, so this is great because we get, thank you, Amy. We get our quirky questions ×2. So these are listener submitted. I don't read them till I open the envelope. So you guys ready?
We're ready.
So
Good news is there's no wrong answers.
Okay.
That's what they always say.
Oh, this is a good one. If you had a time machine, would you go back in time or into the future?
For me, I would go into the future because I would want to know what's ahead. And then I can come back and maybe make decisions based on what I know will be coming up. Sort of like that. Was a Back to the Future movie. When he went to the future and he got the Guinness World Record or something. The book.
So he could make money.
So he could gamble on the right sports teams.
Right.
That's right.
Something like that.
So that's funny because I was going to give my Back to the Future reference, but I would go back in time because I really like the Old West when Doc and Marty went back to 1885. So that's what I would do.
All right. So Amanda, you're going forward because you want that experience and knowledge to make different decisions. And Matt, you're just going back in time, not for anything else other than to strap.
No, I just want to go to a saloon with swinging doors and a piano or something like that.
I have to say, I'm totally with you on that one. I don't know why, and I'm not much of like a history buff personally. Like I think it's cool and intriguing, but there's something about the Wild West and like just this open prairie with nothing, and you just go until you find something. I don't know. That's pretty darn intriguing. So, all right. Question number 2. What's your most unusual talent? Maybe we should have you guys answer for each other. That ought to be an interesting approach to this.
I don't know if interesting would be the right word, but I might get in trouble.
Oh, man.
Most interesting talent. Wow.
I mean, I don't know if it's interesting, but I think for me, I'm really good at explaining something, specifically taxes. I'm really good at explaining it in a way that people will understand, which I think is a problem that a lot of CPAs have. So I don't know, I guess I tend, and I think I'm pretty good at that, even like with kids too, just taking a harder concept, let's say math or whatever, and then kind of like bring it down to a level where they can understand it. I don't know if it's a talent or just more of like a unique ability.
I think for me, I don't know. I mean, obviously we do a lot of public speaking, and one of the, I enjoy doing that, and we both enjoy doing that. But one of the things I try to do when we're on stage is try and make it as funny as possible. Taxes is a boring subject, and I like trying to make people laugh. And some people say I'm funny, some people say I'm ridiculous, but I'll take the good with the bad and keep plowing ahead.
Ain't that
people
the truth?
Engaged when we talk.
Yeah.
Well, there was a time where I wanted other people to think I was funny, and now I'm like, you know what? I think I'm funny, and that's just the way it's going to be. So
I'm good with that. Yeah.
My kids don't think I'm funny.
Of
that's
course.
for sure. Well, I love that you both use CPA, and I think they are interesting talents in the accounting world. And ironically enough, you both went in the same direction, which is, you guys are cut from a slightly different cloth than your stereotypical accountant, not, painting them as bad, but, being able to explain stuff. I think a lot of accountants get in their own way where you can't have a meaningful discussion because it's way over my head, and then same thing with a lot of accountants can be dry and they're just numbers focused and they're kind of quick to the point. But sometimes we do need to chuckle a little bit while we're filling out, documents for tax related purposes. So good for you guys. Last question, popcorn or candy on movie night?
Can I have both? Because I really like popcorn with M&Ms, like mixed together. That's my thing.
So sweet and savory. Okay.
Yeah.
Yes.
I'm going candy all night long.
Mm-hmm.
Till your teeth hurt.
Yes. Yeah. Until I got to pay to get them replaced again.
While watching a Western movie.
Right.
And I love it. Well, hopefully one day you get back in that Western world. If you do, take me with you.
Yes.
I don't know how valuable I'll be. I'm moderate. I feel like I could live outside and I could do that. Like I'm a Florida guy to some degree, but I don't know those conditions without AC and without.
I'm not trying to say I'm tough by any stretch of the imagination. I would be killed probably within a week, but it'd be interesting to see though.
We'll do a day trip, Matt. And we'll get the comforts of our own bed and AC at night. So I like the idea there. Well, thank you for hopping on that hot seat. You're officially off. That is always fun and even more fun when we get to do it times two. So let's kind of walk through, this real estate side and maybe a little bit more practically, right? From a tax standpoint, taxes are personal. There's no one size fits all approach. So I'll throw that disclaimer out for you. There's nothing we're going to talk about today that anyone should say that applies to me or it doesn't. Just make sure you're talking to someone. But what are some of the things that you're seeing, top one or two things maybe that are missed by the average real estate investor? Let's say that it just at least owns one investment, passive or active. But like, what are some of the things that maybe they could or should be thinking about or working through?
Yeah, it's a great question. I think the probably the one that comes to mind the most for me is that, especially with those people with one property, or maybe the beginner investors who are kind of getting started, and they just like, in their mind, I got one property. I'm not a business owner. I'm just kind of a side real estate investor. What happens a lot is they overlook a lot of deductions that they're entitled to take. So, real estate investors obviously are pretty good about capturing mortgage interest, property taxes, insurance, kind of those things that are, tied to a property. But it's more like the overhead costs of being a business owner, being a real estate investor. It's the professional dues. They're going to conferences. They're business meals, business travel, home office deductions, just kind of name a few, right? A lot of times people overlook these for various reasons. They don't know they can deduct them. Books aren't organized, or maybe that CPA's got tunnel vision and saying, hey, that's not going to benefit you right now because, you make too much money or you're not doing it full time, whatever the reason is, right? So a lot of times we see those deductions overlooked that can add up to thousands of dollars and save you taxes at some point now or in the future for sure.
And for some reason, people always think that they have to have like an LLC or corporation to take these deductions. And it's actually not true at all. The IRS doesn't care about a legal entity or lack of legal entity. What they care about is whether an expense is ordinary and necessary to you as a real estate investor. So, what's ordinary to you might be different than what's ordinary to me. But really important, because I think that's one thing we hear a lot. People are like, oh, I know you said I could write off my car, but I don't have an LLC yet. So we always say, you don't have to have an LLC. If you use your car for business, you can deduct the business use portion of it.
So I can definitely agree to that. I hear that quite a bit as well. And that's very good advice. The structure in which you organize your business is unrelated to whether or not the expense is a true expense that can be deducted. So, and then, thinking about what, as investors, I think, this is just some guidance and please tell me if it's misguided, but, save every expense related to every expense that you think may, be considered deductible. I'd imagine it's a lot easier for you to get a nice spreadsheet of everything they spent and delete out what's probably not eligible than it is to try to pull, information out about what they spent or understand where they spent.
Yeah, I mean, one thing I always tell clients is you are the first line of defense. So when you spend money on something, always ask yourself, is this something that is a ordinary and necessary expense? If so, keep a copy of the receipt. If you're unsure, that's what your CPA is for, right? You can ask them, preferably before you spend the money, on whether it's deductible, which account should I pay from? Is it this account or that account or an LLC account? And that's so important because if you are not tracking those expenses, then there's like a 100% chance you're not going to deduct it because your CPA is just not with you day to day. So like we don't even know you spend money on something if you are not telling us or you're not tracking it or paying with the right accounts in the bank or the right cards.
Does the credit card, statement suffice as a receipt, or is it, do you need an itemized receipt? And I'm, asking partially personally, but I think for a lot of people, I encourage investors is, depending on how they own the property, when they own it personally, is like have a credit card for that and put everything related to it. So it's almost like creating organization for people like me that are unorganized. But how important is that secondary, documentation beyond that statement itself?
Yeah, no, that is good advice. I mean, I think if someone's going to have a rental property, that you own personally, do you technically need a separate credit card? No, but to your point, it makes things a lot easier when you're trying to segregate personal expenses and business expenses because hey, everything on that card is related to that rental property. That makes the record keep easy. But to your other question, technically, yeah, the credit card statement by itself is not enough support. The reason being is, think of an example. I don't know. Maybe your spouse goes to Costco all the time and buys a lot of things. You don't know exactly what was paid at Costco if the credit card statement just says Costco, right? So that's where the receipt's going to come in handy to kind of show what you paid for. You can also write handwritten notes on the receipt. Bought this for whatever reason. Take a picture of it, right? You don't even have to keep the receipt anymore. You can just scan it, put it in your computer file folder, and for February or whatever, and you should be good to go as long as it's got the notes on there. The credit card statement obviously can help, but that's not going to be enough.
Awesome. Well, I know the Costco feeling as well. Personally, I have to tell you just a quick sidebar because this came as kind of a total surprise to me. But my wife and I were in Switzerland, and we were sitting in like a restaurant, wine bar, and we were chatting with a couple of the girls that were working there. They spoke really good English. It's a delightful conversation about life and what difference between the way the world works. And the question came up of one of the girls said, I just want to go to the United States so bad. And a question either my wife or I asked was, where do you want to go? What do you want to do? And I promise you, without hesitation, the first girl said, I don't know, like New York, LA, really anywhere with a Costco.
That's awesome.
Yeah. And I thought, well, that's kind of, New York, LA, Costco. That's kind of
anywhere in between.
Yeah, maybe the Chamber of Commerce for the United States is missing out on, we're highlighting the wrong.
Sounds like a golden opportunity. Yeah.
Yeah. And there, when we got into it and again, not to divert too far, but, she just said, we just want to buy stuff in bulk, like our lives are, we stop and buy food daily. We have a tiny little fridge. We don't have storage. We don't have a, butler pantry where we can store stuff. Like I wouldn't even know where to put 36 rolls of toilet paper if we bought them in one package. So anyways, I think all that to say the world's conditioned to love Costco. So no surprise there at all. What about, as an investor from a strategy standpoint, right? So we talked about, hey, I already own X or Y, right? What can I think about? What would be your guidance? Let's say to me, and I own real estate, not a ton, but a decent amount, over the years. I would say a part-time real estate investor, both passively, probably like you. I have a day job that keeps me very busy. what advice would you have or guidance for people like us? Is there things we can be looking at? Are there maybe types of assets that we could be considering that maybe just help with that long-term financial plan or tax plays we can make today? Yeah, where to start?
I mean, for people who still run a business or have a W-2 job outside of real estate, and real estate is sort of like their side income, at a minimum, what we look for is how do we get tax-free or tax-efficient income from our rental property? So it's a lot of the stuff that Matt was talking about, maximizing our expenses. Obviously, we can all take depreciation or even accelerated depreciation, and just using some of those traditional strategies to not have to pay taxes on the cash flow that we're getting. Now, if you are fortunate enough to be married to someone who doesn't have a full-time job and can focus more on the real estate side, and that's sort of where the magic happens, where if we have one spouse that could be a real estate professional, now we unlock the tax situation where now our rental losses from the tax return doesn't just offset rental income, but it also offsets taxes from W-2 income or income from another business. But for some of our clients who doesn't really meet either of those profiles and is really single person, or maybe two people are both working full time, then what we really look at right now, recently in the past couple of years, has been the short-term rental tax loophole.
Yeah, the short-term rental. A lot of clients are investing in short-term rentals. That short-term rental loophole is a good strategy for those who can, either you're single or you're married and both of you are working full time, but you can do a little real estate as a side hustle on the side. So as long as people who can buy short-term rentals and self-manage them, and there's different thresholds you need to meet in order to do that, but it's a way to kind of convert that rental property from being a passive rental to a non-passive. So if we can strategically create a loss on paper through depreciation, maximizing our deductions, it gives us that ability to use that short-term rental loss to offset our W-2 and other income, just like a real estate professional would do for long-term rentals. But this is more for short-term rentals, a little bit easier thresholds to meet.
Wonderful. Well, we'll certainly hope listeners are taking some notes down, and that's all part of being strategic. Let's talk about this real estate professional designation, right? It allows you to unlock, to use your terms, this kind of additional tax benefit and opportunity. What does that look like? Let's say someone does meet that criteria. They're maybe have married and someone only has the ability to quote unquote become a real estate professional. What does that mean? What does it entail? Do they need a real estate license? What does that look like? And then what's the benefit on the back end of that?
Yeah, I think I'll start with the benefit. The benefit is that if you or a spouse is a real estate professional, then you can use your rental losses from depreciation, write-offs, and all that. You can use all of that to offset all types of income. So it's no longer just limited to offsetting rental income. Now it offsets my W-2 income, or if I'm retired, it offsets my retirement distribution income or my spouse's business. And so, this is typically the example where you hear people say, "Oh, my business made $500,000 and I paid no taxes." Well, odds are they're married to someone who is a real estate professional. Real estate professional, there's a couple rules you have to meet. There's actually 3 rules. The first one is you have to spend or earn at least 750 hours in real estate. And then the second one, which is probably the hardest one for a lot of people to meet who have a job, is the second one is you have to have more hours in real estate than your other jobs combined. So if I'm working full-time, 2,000 hours at a job, then it's very unlikely for me to also spend 2,000 hours on real estate stuff. So this is a lot more common when we talk about people who have part-time jobs or a stay-at-home spouse who's not working. And then the third requirement is just meeting material participation for your long-term rental properties. And that usually is defined as just having hands-on hours that really impact the day-to-day operations of your rental properties themselves. So once you meet all 3 requirements, then you are a real estate professional. And like you said, Jason, this is true regardless of whether you're licensed in real estate or not.
So, just to illustrate that, if somebody, if I own 10 properties and add a property manager, is that makes it harder for me to kind of have that material, time, both in terms of hours required as well as the material interest in real estate. Is that a fair way to look at it, or is that something that you would recommend someone, probably?
Yeah, that's a great example of a situation where it would be challenging for them to qualify, because if you have, even if, there was a court case years ago, I think, great example, somebody that had like 40 or 50 properties, somebody, gentleman in the 60s, he was retired. Well, obviously you think, well, he's got 40, 50 properties. I mean, all he does is real estate. Like, he's got to qualify, right? Like, no, because he had property managers. Everything was very hands off. He wasn't putting in enough hours. He wasn't doing a lot of the day-to-day stuff. So in that situation you just mentioned, we would kind of work with that client to say, hey, is there a way that we can kind of tweak your involvement so that you can get involved in enough in maybe half those properties to get enough hours to meet those thresholds? Because again, the benefit is if we can, with 10 properties, right, in your example, if you can do maybe a cost segregation study to kind of accelerate or catch up on some depreciation that, maybe you should have done depreciation one way for the last 5 years and you didn't, and now we can get a catch up. There's a lot of opportunities to create these big losses on paper in your tax return that if you can qualify as a real estate professional, if you got a, I don't know, $100,000 loss in your tax return, you can use offset W-2 income and you're at 40% bracket. That's going to save you 40 grand in taxes, right? So the benefits can be there, especially as you add up the number of properties.
And I also think too, the benefit of all this is, as property owners, we are in control of how much or how little time we spend on the properties, right? We can design it so that it allows us to earn our hours. So if you're someone with 10 turnkey out-of-state properties, property managed, is going to be very difficult. But what if you had 10 out of state, but you had 1 or 2 in state as well, that you could be hands-on and manage and earn those hours? The beauty is IRS allows you to do what we call an aggregation. So you don't have to meet the hours with every single property, as long as a portfolio, if you meet the hours, then you could still be a real estate professional and qualify for all of those requirements too.
Well, that's so cool. And I think there's probably so many people that are leaving that on the table as an option. So I appreciate you guys highlighting that. If you're listening today and you own really, a property, maybe a couple, that's massive. Again, it goes back to that kind of comment from the beginning. It's not how much you make, which is important. It's how much of what you make you can keep. And that's certainly, I think, the genesis of what we're talking about today. Well, listen, you guys have been exceptional. I love talking taxes. I love giving people insight. I think all too many people, they love real estate, but they kind of overlook and miss a lot of this opportunity that's at surface level, and some of it that's a little bit more sophisticated, but available to everybody. You don't have to be a high net worth individual and be at the Big Four accounting firm to get this stuff. So I'd encourage you to, talk to your own accountant about it today. If you're dealing with an accountant that doesn't understand real estate, it's not a bad thing to say, you know what, maybe it's time for me to move to a new accounting firm, to people that speak my language and can help guide me. There's just too much money to be left on the table. So we'll throw, Amanda, Matt, we'll throw your contact info down in the show notes if anybody wants to reach you guys. Any parting words as we bring the show to a close?
I think that the main thing, if you're serious about saving on taxes, or if you're just a real estate investor in general, make sure to take the time to do planning. And when it comes to planning, the earlier you do it, the better it is. We were talking that, in May, sort of like 5 months have gone by, but you still have the rest of this year to kind of design your facts and really implement some powerful ways to save on taxes. If you don't start thinking about it until November and December, oftentimes then there's, limited strategies that could be applied.
Yeah, and again, if we had that time machine, we could go back to 1885, see if they even had income taxes back then. I don't think they did, but that'd be interesting to find out, though, for sure.
Well, they had taxes. They just weren't income taxes. They were, whatever taxes were on the other side of a 6-shooter that you had in your pocket. I would imagine. I bet it was some wild times. Well, listen, I got one last question for you. Same question we asked all of our season 2 guests before we completely let you off the hook here. And we call this last closing session, what keeps you up at night? So we'll start, Matt, with you. What keeps you up at night?
I think what would keep me up at night is the uncertainty about the tax code and the tax changes. And, obviously we're in an election year, and, all political commentary aside, the Biden administration's been talking about changes for the last 4 years that really hasn't panned out. Interesting to see if anything pans out in the next 4, 5, 6 months, or what happens with the election. So I think that's the uncertainty there is what kind of would keep me up at night as a professional.
For
Amanda,
me,
yeah, what about you?
on a similar note, our government has been printing money for years and years. And I'm of the opinion that it has to be paid at some point by someone. And I would imagine a big bulk of it will be from taxes, whether it's tax increases or, as we already know, there's a huge increase in IRS audits as a result of it. And so I think what keeps me up at night a lot is, what does that mean? It's are the auditors going to be reasonable? Are they going to actually follow the law? Or, we've seen in a lot of case history that a lot of auditors are just like, I am the law, and therefore what I say.
1885, I'm the law.
I'm the
That's
law.
right.
So I'm hopeful that we get, I think it's okay to have more auditors, but just better auditors who actually follow what the law says and really be fair to taxpayers at the same time.
Yeah, well, that is without question. If that's not keeping everybody up at night, maybe not all night, but people should be understanding, and it's not a political comment. I appreciate, Matt, you kind of saying that. It's just the reality of how political parties and administrations and taxes work. And you have, either an outgoing party and an incoming party. And as a result, they try to get as much in and as much out, as they can. And so, definitely something to watch. And you got, as I think we're starting to see more and more of these polarizing elections, and they have polarizing effects on our planning, decision-making, what we do. And so now more than ever, do you need good, competent professionals in your corner to help you navigate through it? No matter what's changed, we'll survive, right? At the end of the day, we'll figure it out. But it'd be a shame for us to miss opportunity, a year from now that was available to us today, just by simply burying our head in the sand and saying we don't want to, to get up and look. So, Matt, Amanda, thank you. Love the discussion today. We'll definitely have to get you guys back on in season 3, maybe when you come up for air the last few bits before tax season. So maybe kind of a November session on some year-end planning tips.
Oh, yeah, that sounds great. Thanks for having us.
Yeah, thanks for having us, Jason. Appreciate it.
Absolutely. And to our listeners, thank you so much for continuing to join the show. If you have ideas or commentary on anything that we've done to date or what you'd like to see in the future, please email us at allaboutalts@newviewtrust.com. Otherwise, hit the like, share, subscribe button. Help us grow the community. But otherwise, happy investing, and we will see you guys next week.
Thank you so much for listening. We hope the information within this podcast has given you the tools that you need to find your way to financial independence. We would love to partner with you on this journey. Text ALTS, that's ALTS, to 407-708-1853 to learn more about how to get started today. Don't forget to follow us to make sure you don't miss a second of content, and we'll see you next week.